If you open up your 401k statements right now, there is a very high chance you will see options for index funds. You might see names like the S&P 500 Index, Total Stock Market Index, or a broad bond index. For decades, traditional financial advice has repeated the same mantra: just put your money in index funds, low-cost passive investing is king, set it and forget it. When you transition from saving for retirement, what financial planners call the accumulation phase, to living off your money, the distribution phase, holding index funds in your 401k introduces a completely different set of risks and opportunities. The question isn't simply whether index funds are good or bad. The real question is, are index funds the right tool for where you are in life today, and how should you be using them when you can no longer afford to wait out a massive market crash? To answer that, we first need to look at why index funds became the go-to option for 401k plans in the first place. An index fund is designed to simply track a specific group of investments rather than picking individual stocks. An S&P 500 index fund, for instance, holds shares in 500 of the largest publicly traded American companies. Because there is no expensive portfolio manager trying to beat the market, the fees on index funds, known as expense ratios, are rock bottom. In many employer 401k plans, active mutual funds might charge you 0.8% or 1% every single year in management fees, while a broad market index fund might cost you 0.03% or even less. Over a 30-year career, avoiding high fees can easily save you hundreds of thousands of dollars. Index funds also give you instant diversification. Buying one share of a total stock market fund means you instantly own a tiny piece of thousands of businesses, preventing a single company's bankruptcy from destroying your life savings. However, as you approach or enter retirement, the fundamental nature of index funds reveals a major blind spot that catches many retirees completely off guard. Index funds are entirely passive. They do not hold cash to cushion a fall, they do not buy defensive stocks when times get tough, and they do not manage risk dynamically. An S&P 500 index fund will faithfully track the index straight up during a bull market, but it will also track it straight down during a crash. If the stock market drops 35% or 40%, your stock index fund in your 401k will drop by that exact same amount. When you are 30 years old, a 35% market drop is actually a good thing. When the market eventually recovers, say, gaining 30% a few years later, that 30% gain applies only to your remaining $650,000, bringing you back to just $845,000. You have permanently destroyed a portion of your capital because you were forced to sell shares while they were down in order to fund your life. Even if the market averages a healthy 8% or 10% over 20 years, a bad sequence of returns in years 1, 2, or 3 of your retirement can cause your money to run out long before you do. So does this mean you should abandon index funds in your 401k altogether and move entirely into safe assets like cash or CDs? Absolutely not. Moving everything into cash or fixed income creates an entirely different threat: inflation risk. With people living well into their 80s and 90s, a retirement can easily span 25 to 35 years. Over a 20-year period, modest inflation can erode nearly half of your purchasing power. If your entire 401k sits in low-yielding safe accounts, your money will slowly lose its ability to buy the goods and services you need down the road. You need growth, and stock index funds remain one of the most effective, low-cost engines for inflation-beating growth ever created. The solution lies not in avoiding index funds, but in changing how you organize them within your 401k and how you structure your overall withdrawal strategy. Instead of treating your 401k as one single pool of money invested in a single broad index fund, you can implement a structured multi-bucket or multi-asset approach using the index funds available in your plan. Here is how you can practically apply this strategy to protect yourself while maintaining long-term growth. First, identify the different asset classes available inside your 401k plan. Almost every workplace plan offers at least 3 core types of index funds: a U.S. large cap or total stock market index fund, an international stock index fund, and a total bond market index fund. Additionally, many plans offer stable value funds or short-term money market options. Second, separate your retirement money by timeline using a bucket framework. Your first bucket is your short-term income bucket. This consists of 1 to 3 years' worth of essential living expenses that you will need beyond your guaranteed income sources like Social Security or pensions. This money should never be sitting in a stock index fund. Instead, keep this portion in stable, ultra-safe options within your plan, such as a stable value fund, money market fund, or short-term bond index fund. The purpose of this bucket is complete preservation of capital. If the stock market drops 40% tomorrow, your living expenses for the next 3 years are completely safe and untouched. Your second bucket is your midterm stability bucket, covering years 3 through 7 or 8 of your retirement. This bucket is designed to provide modest growth while protecting against major market volatility. Inside your 401k, this is where intermediate bond index funds and conservative balanced funds belong. If a major stock market crash lasts several years, this intermediate bucket acts as a secondary buffer, allowing you time to rebuild without ever touching your growth assets at a loss. Your third bucket is your long-term growth bucket, covering years 8, 10, and beyond. Conversely, during a market pullback, rebalancing allows you to move funds into stock index funds at lower prices, setting you up for future gains. Index funds inside a 401k are not inherently dangerous for retirees, nor are they a flawless set-it-and-forget-it solution on their own. They are powerful financial tools. Used blindly, an all-stock index fund strategy can expose you to severe sequence of returns risk right when you need stability most. Take a look at your current 401k menu today, check your allocation, and ensure your investment mix matches the timeline of your retirement needs.